Hi, good afternoon. Welcome to the marketplace. Coming up, transport operators may soon have fewer excuses for not reducing fares. This follows a directive by the Abosokai spare parts dealers instructing members to adjust their prices in line with the recent appreciation of the cedi. Meanwhile, the spare parts dealers say reductions may take a while, citing cedi's short-term gains.
At the moment, we can just reduce the prices of our goods because the goods that we are having here is an old stock. You understand?
Also, government fails to meet its Treasury bill's target for third consecutive week, but interest rates are on a falling spree. My name is Darryl Kwao. Thanks for being with us. Details coming up. Thanks for being with us, everyone. Transport operators may soon have fewer excuses for not reducing fares. This follows a directive last week by the Abosokai Spare Parts Dealers Association instructing members to adjust their prices in line with the cedi's recent appreciation. George Afe has more.
The Private Road Transport Union, GPRTU, and other unionized transport operators had in the past depended heavily on prices of petroleum products going up to push for an increase in fares. There was even a convention in the past that any time prices of petroleum products go beyond 5% in a quarter, that should trigger discussions for fares to be increased. But it appears this is changing. Fuel prices since February this year has witnessed some significant reduction. But the GPRTU says this is still not enough to warrant a reduction in fares. They are now citing the cost of spare parts as a major factor. So, following the significant drop in prices of petroleum products, the cedi's appreciation against the US dollar, and now that the cost of spare parts could be coming down in the coming days, what could be the next excuse for not reducing fares? Could it be the cost of insurance for these commercial vehicles? Well, time will tell.
Well, earlier, joining Siseme Fakpesu visited the spare parts hub at Abosokai in Accra to find out if dealers are responding to calls to reduce prices as a result of the cedi's gains.
You should adjust your prices at least so that the public can feel the impact of the appreciation of the cedi. What do you have to say to this? Okay,
at the moment, we can just reduce the prices of our goods because the goods that we are having here is an old stock. You understand? So right now we need to sell them, or we need to get time to sell them, and after that we need to buy new goods. If actually the prices or the rate, that's the dollar rate, remains the same or even stable, that's when we can say we can adjust the prices small for customers to buy.
But for the spare part dealers, are you feeling the appreciation of the cedi? Is it affecting your importation?
For now, I have not done any. I've not bought any goods. So for now, I can't speak for a fact that goods things have been like I don't. For now, I don't see it. Do you understand? For now, I don't see it. But until I buy goods, that's when I'll know.
If you get the assurance from government that they are going to stabilize the cedi for maybe a period of 5 months, 6 months, are you going to reduce your goods for the public?
Yeah, why not? We will. If only they assure us That's after that, after when we've been able to sell our old stocks. You understand? After that, we can do that.
So until you are sold out on old stock, you cannot reduce prices on your spare parts?
Not sold out totally, but if we know how we do our things, so if we are able to sell part of our car parts, that's when we will know whether the new goods come in, we can reduce them or we cannot.
It will be possible because meanwhile I've been changing dollar about 15.75 as just about 2 months ago, and the goods just arrived about 2 weeks ago. So it's possibility for me to changing that higher amount and lose that now. It's going to cost me definitely. So if only it will be better that dollar will come to stay about like other countries. When you go to South Korea, you go to like Dubai and them, they don't have any problem here.
All right, in a separate development, more oil marketing firms are reducing prices at the pumps. Goil has announced another reduction in prices of petroleum products. From what they put out last Friday, it is now selling a litre of petrol at 13 cedis 27 pesos, whilst diesel is going for 13 cedis 87 pesos. Another major player in the industry, Allied, is selling a litre of petrol at 12 cedis 65 pesos, diesel going for 13 cedis 85 pesos. All right, time to turn to the financial markets. Investor demand for Treasury bills remains subdued as the government missed its target for the third consecutive week. This is according to auction results released by the Bank of Ghana. Despite the weak demand, interest rates continue their downward trend. Head of Finance at Merban Capital, Nelson Kujo-Kwagbeji, joins me on Zoom. Good afternoon to you. Let's begin with how the auction went last Friday.
Thank you very much, Darrell, and good afternoon to you and your cherished viewers and listeners. Yes, for the third consecutive time, we have witnessed an undersubscription to the tune of 19.91%. On the 5th of May, we had an undersubscription of 16%. On the 12th of May, we had undersubscription of 3.15%. And as of the trading that we had last week, the undersubscription was 19.91%. where the target was 6.6 billion Ghana cedis, but the bids that were tendered was 5.3 billion Ghana cedis. So we had an undersubscription to the tune of 19.91%.
All right, it's a third consecutive week that the government has fallen short of its target. What does this signal about investor confidence in short-term instruments?
All right, we cannot really use the short-term instruments to actually determine investor confidence. Don't forget that no matter how low the rates are, investors will still go and invest. In fact, the money market, the treasury bill market, is a liquidity management market for both investors and the government. So a typical pension fund manager may always want to allocate part of his or her portfolio to the money market so that if somebody comes for redemption, he can quickly fall on that to pay the person. The government also used the money market or the treasury bill market for the purposes of refinancing maturing obligation. And so no matter how low the rates are, we will still see investor confidence within the short-term market, maybe purposely for liquidity management purposes. And so based on that, we can say, well, there is level of confidence, but we can't use the short-term market to determine the level of confidence within the financial market.
Yeah, very well. But we are also reporting that over 80% of the bids went into the 91-day bill. So why do you think that investors are heavily skewed towards the shorter end of the yield curve? And are they signaling uncertainty or simply chasing liquidity?
All right. So as I did indicate earlier, liquidity management could be one of the reasons why they are tilted towards the short term, the very short term market, because somebody may want to put his money there for the purposes of managing liquidity. Another reason could also be that, well, as it stands now, there is no viable alternative investment. And so let me lock up my money there for 3 months and see if there is something that will come up in terms of investment. So I'll just take my money from the 3 months, treasury bill and inject it into the alternative investment. It will also mean that the investor is trying to manage risk. don't forget that there is always price volatility. And so he will prefer to do 3 months. Then when he gets maturity, he will roll over again for another 3 months. So that if during the previous auction there was a loss, he can recover in subsequent, reinvestment. So these are some of the reasons why the investors are tilted towards the 91-day Treasury bill.
And again, interest rates continue to fall, is on a falling spree. What's the explanation for what we are seeing continue to happen? Is it a sign of a policy shift or a market distortion?
All right. Right from day one, we have seen that the tone of government is to cut down on expenditure. So this is largely due to government policy shift. So government intentionally decided to shy away from the market in order not to incur so much cost on interest payment. In fact, if you look at a typical government financial statement, you realize that we have compensation, we have goods and services, and the third element we have is interest payment. And if you look at the government financials for some years now, you realize that a lot of money goes into interest payment. And that will, of course, affect other areas of development. So I think government really wants to cut down significantly on its interest payment in order to have some fiscal space to tackle other aspects of the economy. So I think it's a clear-cut government policy shift not to pay so much on their borrowings.
Are things working according to the government's plan?
Well, to the extent that the rates are coming down, to the extent that the government's interest payment cost is significantly coming down, we can conclude that yes, things are working in favor of government per their own policy that they are implementing.
Yeah, and so what's the outlook? Do you anticipate a further drop, for instance, in interest rates?
Well, I expect interest rates to drop further, but not to the region of single digits. I expect, per our own projection, that interest rate will stagnate around the band of about 12 to 14% by the close of the year. But to descend below, to a single digit, we don't foresee that. But between 12 to 13% band, we expect the interest rate to stagnate there by the close of the year.
Yeah, and for investors who are watching, what's your advice to them looking at what we are seeing currently happen on the market?
Well, I will just advise them that when it is for purely liquidity management strategy, they can still opt for the short-term money market. However, if they want really returns on their investment, there are other equally profitable alternative investment schemes that are available on the market that they can take advantage of. However, in their quest to make those investment decisions, they should try as much as possible to seek expertise advice in making those investment decisions.
All right. Head of Finance at Melbourne Capital, Nelson Kudjo-Kwagwejia, thank you so much for your time this Monday afternoon. I appreciate the perspective. And you're watching The Marketplace. We're taking a short break. We have some more news for you afterwards. And welcome back to The Marketplace. The Bank of Ghana's policy rate is expected to be held steady at 28% with any cut contingent on disinflation progress. That's according to the data bank research. Now, the Monetary Policy Committee, it says, will likely adopt a wait-and-see stance to gauge the impact of prior tightening. The MPC is expected to commence its quarterly sitting this week from May 21 to May 23. A decision on the policy rate will be made at the meeting and consequently announced to the press. Joining me on Zoom is Wilson Zilevu, who is a fixed income and economic analyst at Data Bank Research. Good afternoon to you. Thanks for joining us. So based on your report, you expect the central bank to hold the policy rate at 28% after it concludes its meetings this week. What's your basis for this projection, and would that be a good move? You're muted.
Okay, can you hear me now?
Yes, I can.
Thank you very much. Yeah, so looking at where we are coming from, inflation was relatively flat in 2024. We started in 23.5 and ended the year at 23.8. Okay, the Bank of Ghana's, hawkish monetary policy of 28% was triggered by a lot of factors. It triggered monetary policy consultation clause, and also increased money supply due to election-induced expenditures in 2024, caused them to sort of go on a hawkish tone to sort of tame expectations in the market. So looking at this hawkish tone at 28%, it will be quite unexpected if there's any cut, and any cut would likely undermine policy credibility. So on these particular basis, we expect a hold to measure the impact of the hike, to see how best inflation, progresses downwards, or how best prices slows on the market before any potential cut is made, probably in July. So if you look at the inflation figures, you realize that although there were marginal declines in both food and non-food inflation, month-on-month inflation edged up a bit from 0.2% to 0.8%, indicating that there are some pass-through inflationary pressures still lurking. And based on these fundamentals, I think the Bank of Ghana would, adopt a wait-and-see approach to see how best their hike can tame expectations to cause further declines in inflation.
Yeah, and seeing that inflation is key in the decision-making process, what's your outlook for inflation?
Okay, so our outlook aligns broadly with the Bank of Ghana's inflation target of 12%, and these are likely to be anchored on a lot of factors. One of the factors is a base effect drift. Darrell, you know that this year there was a rebasing of the CPI with 2021 figures, or 2021 prices as compared to 2018 prices. So a base effect drift will largely aid the downward trend in inflation. We've also seen supply dynamics improve strongly. Supplies of key staples that carry a lot of weight in the CPI basket have, made way into the market, easing price pressures largely. We've also seen a very stable Cedi run, even recording strong nominal appreciations against the dollar. And all these dynamics should, augur well to aid a steady disinflation by year end to 12%.
Meantime, the city is enjoying good times, good moments. But question is for how long? And so people are questioning whether or not this good run will be sustained. What are you reading at your end?
Yeah, we expect this good run to sustain largely, and it's because of a lot of factors. So first and foremost, reserves are in a very strong position due to an IMF anchor. Also, external, funny enough, the US-driven policies are also aiding us because these policies are causing some depreciation of the US dollar, which is aiding an appreciation of the cedi. But largely, the fiscal measures put in place, the fiscal consolidation measures in place have, sort of constrained government expenditure, which has eased any, fiscal pressures that might cause demand for the dollar. And also, another major factor is that, apart from these fundamental factors, speculative demand have largely been subdued. And this is because people are optimistic that the rates would, drop further down it works in two ways. If people feel that rates are going to, depreciate on a faster pace, they are going to demand more, which is going to, fuel the depreciation process. In the same trend, if they feel that, based on the fundamental factors, based on the macroeconomic factors that are improving, there's a likelihood that the rate is going to drop further. It is going to largely ease speculative demand for the dollar, which would help the cedi, the cedi. It will help the cedi maintain a stable run throughout the year. So basically, the macroeconomic indicators are supporting the current trend we are seeing. The external factors are also supporting the current trend, and also foreign direct investment has also improved. And all these dynamics are auguring well for the cedi. So we should expect a stable cedi by year end.
Great stuff. Wilson Zilevu, who is a fixed income and economic analyst at Data Bank Research. I appreciate that you are on the marketplace. Great speaking with you for the first time. Hope to have you back some other time. I appreciate your insights. All right, Wilson, thank you. Right, one more story before we go. Social Security and National Insurance Trust, SSNIT, insists that it will not sell or relinquish any of its assets at its disposal. Rather, it intends to review all its investments to improve profitability and ensure value for money. Speaking at a short ceremony to commission SSNIT's new office on the Spintex Road, Director General Cedi Appreciation stated that the new administration at SSNIT will maximize returns by prioritizing high-yielding investments.
Every year, to increase our pension payout, we do what we call indexation, which is actually a function of, you look at the inflation rate, you look at the returns that you are getting, you look at membership contribution, and then you decide to what level do you want to increase pension payout to pensioners. Now, to be able to give more requires us to ensure that our investments are yielding returns that enables us to give more. And that's why I earlier flagged the point that it is crucial that we help change those non-performing assets into performing assets. We've looked at reviewing our investment portfolio. We've looked at which areas are giving us the best returns, and we are beginning to channel our resources into areas that give us the best returns. We've made a decision that the fixed income securities is an area that has been yielding good returns for us. So we would keep pushing quite a number of our investments into the fixed income securities. Some listed equities have done great for us, particularly those in the banks, those in the banking industry, as well as those in the telco space. That has yielded some great investment for us, so it's an area we'll keep pushing money into. Power has been an area where we've had great results, so it's also an area that we are looking at, and that's the reason why our only power plant at Tema, we are expanding SSNIT to have an operation in Kumasi, not only to expand on power provision for the people of Ghana, but also to ensure that since it's an area that is giving us good returns, it should be an area that we enhance our activities in. Watch out for what we will do with our facilities that were to be sold. I can assure you we will not sell those facilities. We'll turn around those facilities and we'll have an event to speak to what we plan to do with those facilities.
Okay, and that's it for the marketplace. Thanks for watching, everyone. More news on our website, myjoyonline.com. The finance minister has been speaking about the cedi. We are heavy on it, myjoyonline.com/business. Goodbye.